Should you pay off your mortgage first before trying to invest in property? Well, a lot of Australians would say yes if they had to answer that question. And to be fair, that sort of advice probably worked 30 years ago. But in 2025, following that old school line of thinking could cost you hundreds of thousands of dollars in missed opportunities. So today, I'm going to walk you through why this old way of thinking about debt could be setting you back and what smart investors are doing instead. I spoke to someone recently who said, Nero, we've been thinking about investing property for many years, but every time we thought about it, we had that old advice from our parents in our head saying, don't get into debt, debt is bad, pay off all your debt. And so we kept putting off buying an investment property. But the problem is now when we look at where prices are, they're so much higher than they were back when we first started thinking about investing in property. And we feel like we might actually be behind. And sadly, I actually see this sort of thinking happening all the time. You see, the idea that you should be debt free, maybe before you invest, is age-old advice. It probably comes from the times when interest rates were at 8% or 10%, when there wasn't a lot of job security. And so paying off the debt on your own home and having a home totally unencumbered with no debt was a great sign of success. And yes, paying off your debt on your mortgage is a goal that you want to achieve, but not at the expense of building real wealth, building maybe a passive income, and securing your retirement. So while that old advice of pay off your mortgage first and as fast as you can may have helped your parents, may have even helped your grandparents, it won't necessarily serve you the way things are going with property. Instead, your biggest asset is your ability to leverage strategically, yes, still safely, so that you can build wealth faster. That's why if you've got your mortgage under control, you are saving extra money each and every month, and your home has now risen in value, instead of trying to pay off your mortgage more quickly, you might actually want to consider using that equity and that extra cash flow to start building a property portfolio earlier than you might have initially thought. Because I'm sure you've seen over the last few years, what have property prices done? In most areas, they're not exactly lower than they were a few years ago, are they? So today, let's have a look at what's actually going to work for you. Let's break down the numbers and see if you've got extra money each and every month, should you pay off your mortgage more quickly? Or would it be better for you to take that money and put it into another property instead? Now, to point out the difference in these two different pathways, let's look at an example scenario. Let's imagine you have a mortgage on your home. You owe around about $1 million, which, yes, I know is probably low if you live in Sydney or certain parts of Melbourne or Brisbane. But just for this example, let's say you have a mortgage remaining on your home of $1 million. Your interest rate is, say, 6.25%, and you have extra cash flow each month of about $2,000. So the question is then, what should you do with that extra $2,000? Most people will say, well, if you've got an extra $2,000 a month, put that into your mortgage, you'll pay it off faster, you'll be debt-free faster, you will win the game of finance. And that might be only partially true, because yes, if you put $2,000 into your mortgage every month extra, you will pay off that $1 million mortgage faster. In fact, instead of paying it off in 30 years, the standard time for a mortgage, you've paid it off in 18 years, 12 years ahead of schedule. You've also saved yourself by doing so over $500,000 in interest, around about $536,000 in interest to be accurate, assuming the interest rate stayed roughly consistent at 6.25% over that 18-year time period. Now, saving over $500,000 in interest is a huge achievement, especially when you consider that that's after tax dollars. So you had to earn money, you then had to pay the government for your tax, and then you used what's left to pay down your mortgage. So saving over $500,000 on your mortgage is the equivalent, depending on what your tax rate is, of earning around about, say, an extra $850,000 over that time period. Sounds like a great achievement, and it is. But What's the cost of that? Well, first of all, hopefully your home has gone up in value, which is fantastic, but more than likely, multiple other areas would have seen properties rise in value as well. And how much would they have risen? Well, in an 18-year time period, it's quite likely that properties in multiple areas would have doubled or even tripled over that time period. If that sounds unrealistic, just go back and look at what's happened to, say, prices in Brisbane over the last 7 years, Adelaide, Perth. They have all risen significantly. So it's quite likely that you would have seen property prices double or triple, like I said, in that 18 years that you chose not to invest in property and instead pay down your mortgage. Secondly, let's assume you were 40 when you got this mortgage, and so 18 years later, you're now 58 years old. Yes, you've got your mortgage paid off, but what about retirement? Maybe you want to retire by 65, maybe 70 if you want to keep working a bit longer. But now, how much time do you have to build wealth if you're only going to start your property investing journey once your mortgage is fully paid off? You're 58 at this time. Okay, all right, maybe you started earlier. Maybe you got your home at the age of 35. Congrats, that's amazing. But still, if you wait 18 years, like we are looking at in this example, so we're waiting until your mortgage is fully paid off, you are 53 when you start to invest in property. Again, then how much time have you given yourself to build a property portfolio that will allow you to have some kind of passive income and a more enjoyable retirement? You see, if you're serious about building wealth, you want to start buying investment properties as early as you can possibly can, as soon as you can afford to, so you have as much time left in the market for properties to rise in value. You see, prices in Australia continue to rise. That has always been the case, and I can't see it really stopping. So over the long term, prices rise. Sure, there are some short-term wobbles, but over the long term, prices keep going upwards. Now, that is a double-edged sword for you, because the longer you wait to get into the market, prices are rising and you're being left on the sidelines. On the flip side, the sooner you get in, the more of that growth you get to enjoy. So now let's have a look at an alternate solution where instead of taking that $2,000 a month that we said you had and putting it towards your mortgage to pay it off faster, instead you use that $2,000 a month to buy an investment property. Let's say, for argument's sake, you buy a property for around about $800,000. You borrow 100% of the purchase price, plus the stamp duty, legals, all the costs. And so that's why the property would cost you roughly $2,000 a month at current interest rates before any tax benefits. Let me make sure I'm being clear here. You are buying an investment property that's costing you $2,000 a month. Now, as a result of that, and for the negative gearing benefits that you get, you might get the equivalent of $800 as a rebate. So really, this property is only costing you $1,200 a month after the tax rebates. So you have an extra $800 a month now. What are you going to do with that? Well, you could put that towards your mortgage, right? So now all of a sudden, you're actually getting the best of both worlds. You're having a property that instead of costing you $2,000 a month, which it still is before tax, but then you get $800 back as a result of having that property. So not the whole amount, but a portion thereof. And you take that $800 and you put it towards your mortgage. So instead of now putting $2,000 towards your mortgage, you're putting $800 towards your mortgage and you have an investment property. First thing, just by putting that extra $800 towards your mortgage, what happens? You still pay off your mortgage more quickly. You pay it off nearly 7 years later, and you still save over $300,000 in interest. So you're still ahead. But the benefits don't stop there. You have an investment property that's rising in value if you bought in the right areas. But here's the thing most people forget. When you buy in the right areas, you don't just get capital growth, you also get rental growth. So your rents rise, which means that the property that's costing you $2,000 a month before tax or $1,200 a month after tax, whatever that figure is going to keep reducing over time because rents will rise. So therefore, you're going to have less of a cash outflow, which will then leave you with a little bit more money to keep putting extra towards your mortgage. Now, let's go back and look at this property. Let's ignore the tax benefits for a moment. Let's say that it's costing you, like I said, $2,000 a month before tax. Then over time, instead of costing you $2,000 a month, it may end up only costing you $1,000 a month because rents have increased, and especially right now with where we are in the interest rate cycle, interest rates might have been cut. Okay, so all of a sudden you are having this property that's rising in value, but it's not actually hurting your cash flow anywhere near as much as you thought. And as the cost of holding that investment property reduces, what could you do? Well, you could either buy another investment property or take now the extra money that you have because this property is no longer costing you as much as it did and put those extra funds towards your mortgage. But here's the big benefit that I haven't yet outlined. This property, remember, we bought it for $800,000. Now, if you hold it for 10 years, what if that's now worth 1.6 million, 1.8 million? Yes, it could easily double in 10 years. Like I said, if that seems incredible or unbelievable, just look at how much property prices have moved in certain areas around the country in the last 10 years. Okay, so yes, you do need to do your due diligence. Yes, you need to make sure you're buying in the right areas. And look, if you want help with that, check out the link in the description below to get totally for free a checklist that shows you the key criteria you want to focus on to maximize the chances of buying a property in the right area that's going to grow in value. But back to what we said, if this property has now risen, it's doubled in value, maybe even more so, let's say it's just doubled in value. Well, it's gone from $800,000 to $1.6 million in 10 years. Now, what could you do with that? Well, you could take out a chunk of that equity that you've got because the property's increased in value and go and buy another property. And over time, what you will find is that the gain in the properties will far outweigh how much you might have saved in interest by paying off your mortgage. So what I'm talking about here is you don't need to earn any extra. You are simply taking the extra cash flow that you have on a month-to-month basis. And yes, of course, you need to make sure that you're spending less than you earn for this to work. But on the assumption that you are able to do that, and in this example, I'm using the fact that you got an extra $2,000 a month, by simply redirecting that $2,000 not towards your mortgage and not towards just spending it on entertainment, but rather putting it towards the right investment property or properties, over time, you are going to see your wealth build a lot faster than if you just focus on reducing your mortgage. Reducing your mortgage is great. Paying it off faster might feel good, but it's not going to get you to where you actually want to get to. Yes, this is going to take a lot of care. Yes, you need to get the right strategy, but done correctly, building wealth through property investing first while keeping your mortgage manageable will help you get ahead so much more quickly. But of course, taking on extra debt does have risks associated with it. I'm not saying it doesn't. That's why my team and we help clients do this every single day. Build wealth through property strategically and safely while having the right buffers in place so they can rest easy. We help our clients buy properties in areas with the right fundamentals where demand is higher than supply, and they can still pay off their mortgage more quickly as well. So like I showed you earlier on, you can have the best of both worlds. So it's definitely possible to do. But if you're still nervous about taking on extra debt while you have a mortgage on your home, I totally get that. But what if I told you you don't have to take on any extra debt in your personal name? What if I told you you could buy property that is fully paid for by your employer and your tenant? Well, if that's of interest, then check out this next video where I talk about how you can use a self-managed super fund or an SMSF to buy an investment property that does not affect your personal lifestyle and, like I said earlier on, is fully paid for by your tenant and potentially your employer.